Hello, I'm Bernard Hickey from Eurostoxx and welcome to 90 at 9. This is your morning briefing where you get everything you need to know in 90 seconds at 9 o'clock, starting now with news that the big bazooka is here. The European Central Bank revealed overnight its plans for unlimited bond buying to try and solve the Eurozone crisis. Nations, particularly in Southern Europe, will have to ask for bailout austerity to be able to get this bond buying. The aim is to reduce the interest rates that governments have to pay in the market to borrow. Now, the European Central Bank will sterilise this buying. That means after it's printed the money to buy the bonds, it will go into the markets and mop it up again with bill auctions. However, this process is going to be called outright monetary transactions. And we've already had the Bundesbank object to this plan in a separate statement. It said it was tantamount to printing money to finance European governments. But it's clear with last night's announcement that the Bundesbank has been sidelined. The Germans aren't happy about it. European stocks, they rose 3.4% on the plan. Eurostoxx up 2% to 4-year highs. European bond yields also fell. And the New Zealand dollar, which is seen as one of those riskier assets that you buy when things are looking good, it rose to over 80.2 US cents this morning. However, will this actually solve the Eurozone crisis in the long term? Because this plan depends on what they call strict conditionality. That means any country like Italy or Spain has to agree to very severe austerity plans. That means increasing taxes, cutting government spending. Very similar in a way to Greece. It too had to agree to this conditionality. This means that the Eurozone breakup is less likely for now. However, it forces Southern Europe into the sort of deleveraging spiral with more austerity, as it has to keep the European Central Bank happy to get the money it needs. The key issue here, watch the politics. It will be the elections as we go forward over the next few years that will decide the future of the Eurozone. It does mean, however, that the Eurozone is unlikely to grow that much, particularly in Southern Europe. And in fact, that was reflected overnight when the European Central Bank revised down its expectations of growth for the Eurozone. It now sees contraction in 2012. However, get this, it's revised up its inflation forecast. Why? Those governments will need to increase their GST rates to make sure they hit their austerity targets. Meanwhile, the European Central Bank also held its official rate at 0.75%. So what does this all mean for New Zealand? Well, less chance of a Eurozone crisis anytime soon, but it means Europe stays weak for a long time and that interest rates stay low for longer. Most economists here expect the official cash rate to stay on hold through until late 2013 or even 2014. The key for New Zealand is China. And remember, the Eurozone is China's largest trading partner. I'm Bernard Hickey. That was way longer than 90 seconds at 9 o'clock from Eurostoxx.co.nz.